Hey everyone, welcome back to Ujaxanti. In this series, we try to understand whether the current rally of Bitcoin resembles more with 2019 rally or with 2020-2021 rally. These two were very different rallies and there are numerous differences, and we discussed those in different parts of the series. In the first 4 parts, we discussed gold breaking out of its multi-year resistance zone. Then we discussed the correlation between Bitcoin and Bitcoin dominance. Then we shed light on the yield curve inversion of 10-year and 3-month, which happened in 2019 and it's still inverted now. And it inverted back in 2022. And in part 4, we discussed 21-week EMA holding a support for Bitcoin during bull runs. So please check the links of those videos in the description. And today, in part 5, we are going to speak about the monetary policy. Namely, we are going to discuss the interest rate decision of the Federal Reserve, the central bank of the USA. The majority in crypto view or want to view crypto assets separate from other financial markets. Thus, they don't look at monetary policy or other macroeconomic data and indicators. The problem is that when you want to buy Bitcoin or other crypto assets, you need money. In fact, you need excess money. Or, for example, disposable income, as it's said in economics. And whenever the Federal Reserve increases its interest rate, the indirect goal of it is to cut the excess liquidity in the markets. So you cannot just ignore monetary policy if you want to invest in any asset. So whether it's equities, bonds, or even crypto, you have to look at monetary policy because monetary policy determines the price of credit and also it determines the liquidity levels in the economy overall. As you might know, the Federal Reserve has dual mandate. They need to keep the unemployment rate below 4%, as well as they need to keep the inflation rate in the vicinity of 2%. And they have 2 primary tools in their arsenal to achieve these 2 goals. Those 2 tools are the decision of the interest rate and open market operations. These 2 tools are usually used together. In today's video, we are going to concentrate on the interest rate decision. And in the next one, we will concentrate on the open market operations. By the way, QE and QT are the non-traditional alternative variations of open market operations. So quantitative easing and quantitative tightening. Those are the terms that we use nowadays. We rarely say open market operations. Now let's get rid of the drawings and let's overlay the chart of federal funds rate. Monthly candles would make it easier to see the whole picture. Unfortunately, as you can see, during Bitcoin's short history, we only had 2 rate hiking cycles. One started back in 2015 and it ended during COVID pandemic when we went down to 0.25%, basically the cheapest credit that we ever saw in the US. And the second one started in early 2022 and we are still in it. One interesting thing when it comes to rate hiking cycles, by the way, a rate hiking cycle is the process when the Federal Reserve increases its official interest rate, which makes liquidity less abundant in the economy and also makes credit more expensive for companies and households. The interesting thing is that it works in lags, so it will affect the economy in 1 or 2 years. So it will not directly affect right now. It's going to affect in the future. There are some academic papers indicating that the usual rate hiking cycle will affect the economy from 16 to 24 months. And because of those lags, the Federal Reserve usually starts to increase its interest rate in anticipation of higher inflation in the future. So they don't wait for the economy to reach the below of top phase and stock markets as well. They start to curb the inflation rate when it's not even high. That's the way the Federal Reserve usually worked. For example, this is Bitcoin's chart. For example, the first rate hike that Bitcoin ever experienced, that started in 2015. Here we can see that the rate hike was during bull run. However, Bitcoin is a small asset class, and back in 2015 it was even smaller. So it's better to view the S&P 500. Bitcoin is small compared to S&P 500, and as of now, in the future, chances are good that Bitcoin will be as big as S&P 500. If we go to SPX chart, let's get rid of the drawings. Here, for example, the same rate hiking cycle was during a bull run. As you can see, and when they finished the rate hiking cycle, then we had a 20% correction in the stock market, in the SPX. Maybe white will be better. And if we go back, because we don't have history before 2008 for Bitcoin, however, we have data points for the stock market, the S&P 500, we can see that before the great financial crisis, the Federal Reserve started to increase the official interest rate well before the stock market went to new all-time highs. Multiple years sooner. So they started the rate hiking cycle in 2004 and they finished it. They started to cut in 2007. Something similar happened during the dot-com bubble. So this rise, again, was when the market was on a rise. And again, it was before the blow of top phase, before the new all-time highs. However, when we come to the last interest rate hikes, the one that we are currently in, this is the S&P 500 chart, by the way. It's not Bitcoin's chart, but it's very similar. We can see that the Federal Reserve started to increase the official interest rate when we had a bear market in the stock in equity market. This is something very unusual because usually the Federal Reserve starts to increase the interest rate to combat the inflation rate well before a bear market starts. Now let's have a look at the year-over-year inflation rate in the US, which is represented by the blue line, and the interest rate of the Federal Reserve, which is the golden line. In the previous rate hiking cycle, which started in late 2015, we can see that the year-over-year inflation rate in the US increased, and simultaneously, the Federal Reserve started to increase the interest rate. So, in anticipation of higher inflation rates, they started to hike, and they were correct. The inflation rate increased in the upcoming few years. But when it comes to the current rate hiking cycle, we see that the inflation rate bottomed in May of 2020 and then spiked dramatically. However, the Federal Reserve didn't start its interest rate hiking cycle until February of 2022. And this was something very unusual. And the reason of this huge spike was that the Federal Reserve printed a lot of money. They started the largest quantitative easing round in the history of the US. And that was because of the pandemic recession, of course, for the stimulus checks. And you shouldn't be an economist to understand that there would be inflation spike. If you go to M2 money supply, let's get rid of this chart. So this is the M2 money supply. Here we can see that the money supply increased dramatically starting from 2020. It increased more than 40% in 2 years. However, in 2020 alone, it increased somewhere close to 24%. And you shouldn't be an economist to understand that if you increase your money supply by 25%, chances are very high that you'll have a spike in inflation rate. However, the chairman of the Federal Reserve, Jerome Powell, ridiculously stated that the inflation is going to be transitory, meaning that it will be abated easily and it will not last for years. However, in retrospect, we know that it was not the case. They were wrong. And currently, the inflation is very sticky and there is a risk of second round of inflation, something that happened in 1970s and it can happen in the current environment as well, indicating high chances for stagflation, which is the worst outcome, worse than recessions. Now let's go back to Bitcoin's chart. And now just comparing the last 3 rallies, the one that we are currently in, then we had the bear market rally in 2019, then we had the parabolic rally after the COVID recession, and then we have the current rally. From the perspective of interest rate hikes, monetary policy, which is the primary tool of monetary policy, we can state that the environment is very similar to 2019. The only difference is that this time the Federal Reserve started its rate hiking cycle later than they should. So they should have started in late 2020 or early 2021. If we add the year-over-year inflation rate, it will be visible here. As can be seen, inflation started to surge in the second half of 2020. And that was normal because the M2 supply increased by 25% in the second half of the year in 2020. And the Federal Reserve ridiculously claimed that it's going to be transitory. They will abate the high inflation rate easily. And because of that, they didn't start rate hiking cycle until early 2022. And when they started with 75 basis point hikes. 75 basis points equals to 0.75%. And as can be seen, the Federal Reserve stopped its rate hiking cycle a year ago. Currently, the interest rate sits at 5.5%. There is no guarantee that they will not continue, but currently that outcome seems unlikely, according to the Federal Reserve's chairman, Jerome Powell. And we can see that the year-over-year inflation rate is sticky. It sits at 3.3% now. However, the target is 2 So at first, we can see that it decreased dramatically. However, now the Federal Reserve finds it difficult to combat the high inflation rate and it's sticky. And if we go to the bond market, we can see that according to the CME group, the chances that the Federal Reserve will cut in July is only 8.8%. And the chances that they will cut in September is 67.2%. However, these numbers change every day. And in the last 2 years, we saw many instances when the CME group and the bond market predicted wrong outcomes. A couple of months ago, according to the same metric, the Federal Reserve was expected to have 5 or 6 rate cuts this year. However, now, according to their dot plots, they are expecting to cut only once. And we can see that we have something similar here in bond market predictions. And a lot of people anticipate that the Federal Reserve will not cut in November because of the political reasons. They want to stay away from politics and they don't want to cut during election month. However, there is high probability that there will be at least one rate cut in this year. So the market predicts that we will see a rate cut in September. But let's see what happens. Coming back to the topic of interest rates and comparison of the last 3 rallies. First of all, let's get rid of the inflation rate and the drawings. We can state that 2019 was the time when the Federal Reserve increased its interest rate, started its rate hiking cycle back in 2015. However, this was the time when it reached its terminal rate, which was 2.5%. And in this cycle, they started it late. That's why they increased it by 75 basis points for a couple of times. And now the bond market predicts that they will start with their first cut in September. From this viewpoint, if we only view Bitcoin's price and Bitcoin's actions in these 3 separate rallies, from this viewpoint, from the viewpoint of interest rates, we can state that we are more similar to 2019 scenario. And actually, the logic is very simple. Because whenever the Federal Reserve increases its interest rates, its main target is to combat inflation rate. And how do you combat inflation rates? You just need to cool the overall output of the economy. You need to cool off the economy, and you do it by making credit more expensive. So whenever the interest rate is 2.5%, it's more expensive to service loans or mortgage than when it's only 0.25%. Companies cannot service their new and existing loans. Households cannot or find it more difficult to service their mortgages, car loans, student payments, credit card payments, all other debts. And that makes extra money, extra liquidity or excess liquidity less. And even if you are the most bullish person on Bitcoin, you need money to buy Bitcoin. And if the interest rate becomes high, you just have less excess money. And by definition, you cannot purchase Bitcoin enough. I mean, you will buy more when the interest rate is 0.25%. You will have more excess money. However, in this situation, in 2019, for example, you just don't have it. The general public, of course. And that's another reason that Bitcoin outperformed in 2019. Because for altcoins, you need new investors. If you don't have marginal new buyers of your altcoin bags, altcoins will underperform Bitcoin because people don't have excess money to buy altcoins. And we know that in altcoin market, we need more newcomers. We don't need people from the last cycle. We need some new marginal altcoin buyers. That's why this cycle was only Bitcoin cycle. Altcoins, of course, rallied in terms of USD, but altcoins in general underperformed Bitcoin because of the macroeconomic conditions and because of less liquidity. And the reason that Bitcoin can rally and can outperform altcoins during these difficult macroeconomic conditions, like in 2019 or like in the last year or so, is that Bitcoin has a strong narrative of being digital gold. And there are a lot of individuals and companies that buy Bitcoin regularly. For example, there are many companies, including the MicroStrategy of Michael Saylor. They just DCA into Bitcoin. They never buy altcoins. So Bitcoin has a big demand driver because it has a good and strong narrative of being digital gold. And a lot of companies started to buy Bitcoin and hold it in their treasuries. And there are a lot of Bitcoin maxis. They just buy Bitcoin by DCAing into Bitcoin because they are sure that Bitcoin will be around after 10 or 20 years. But probably they are not sure whether Cardano or any other altcoin will be around in 20 years. So we have more people buying or DCAing into Bitcoin, even in harsh environment, in difficult macroeconomic conditions, than we have for altcoins. Altcoins need good monetary policy, which is expansionary monetary policy. They need quantitative easing in order to thrive and outperform Bitcoin. And we saw that happen in 2020, 2021. We had QE, the interest rates went to basically zero, it was 0.25%. We had like 30% new money in the M2 money supply. Those are the conditions that altcoins need in order to outperform Bitcoin. That's why we didn't have altcoin season in 2019. And we didn't have alt season in this rally. Bitcoin outperformed the general altcoin market here and in 2019 just because of all these mentioned factors. To sum up then, from the perspective of interest rates, we can say that the current environment is very similar to 2019. And we know how it ended. It ended with a recession. And usually we know that the Federal Reserve cuts rates when a recession arrives. That was the case in 2008. That was the case during the dot-com bubble. And that was the case in COVID recession. Of course, some people will argue that the recession materialized because of the pandemic. However, we can remember that there were signs that the economy was not healthy. And the US 10-year and 3-month yield curve was inverted in 2019, indicating that the bond market is not efficient and indicating that there is a high probability of a recession. And it occurred. So it's very difficult to say whether it was due to macroeconomic conditions or due to the pandemic. However, we can state that after the interest rate hikes, the Federal Reserve cut its rates to basically zero, to 0.25% when we had the COVID pandemic here in March of 2020, the recession of COVID pandemic. And we can have something similar in this cycle. So we should stay open-minded to the idea of recession and correction. And if that happens, the chances are high that it will affect altcoins more than Bitcoin because Bitcoin is considered the safest altcoin and a lot of people will move their money from altcoins into Bitcoin. And chances are high that a lot of people will not sell their Bitcoin. However, they will sell their altcoins. So it will affect altcoins a lot more than Bitcoin. And it may be a great chance to buy altcoins. This was the content that I wanted to share with you today. I hope you found it informative. If that was the case, please like and subscribe. And thank you for watching. I'll see you next time.